And good morning once again, options traders. I hope everybody had a great holiday weekend and looking forward to some more market madness. And I thought this would be a great topic for any markets, but especially the markets that we're in now. And that is to understand that options sort information. The options market is an information sorting machine. Unfortunately, a lot of traders look at options as ways to make directional bets. I think the stock is going up, I'll buy calls. I think it's going down, I'll buy puts. But that reference frame is going to cause you to make bad decisions because now you think that everything is about options being a race against time. I need to sell options against my position, or I only need to be an option seller. I just can't expose myself to this time decay. And that is not what options are here to do. They are to sort information. So let's go find out why. And once you make that mental shift, it's going to explain a lot of things. Why options eventually go delta 1 or delta 0. Why gamma appears. Why everything tends to compress from the tails inward. And once you see that, it's going to really change the way that you see options. So let's go find out why options are a way to sort information. As always, before we do, please be sure to click like and subscribe. It's greatly appreciated and helps so much to promote the channel. So the first thing to understand is that options are about information over time. So we've seen this chart before here where we have time going horizontally here, but we also have information going off in this direction. And most traders see that we're just moving through time. That's what we look at when we look at our chart. We see the horizontal axis as time, and then we see our candlesticks moving through time. But they never make the connection that the reason that those candlesticks are moving is because the market is resolving information. So the first thing to understand is that they move through this space called information time. So once you see that, we can answer an important question. Do options decay? So let's look at a $100 call trading for 3. You look on your broker's platform, it shows a theta of 0.02. And once again, what that means is that all things being equal, tomorrow, this $3 option is going to lose 2 cents and should be trading for about $2.98. So it looks like we've got a long time before this is going to decay the full $3. But now let's say that the very second we buy this option, the stock jumps to 120. Some big piece of news obviously came in, some information, and the stock goes to 120. And now you look at your broker's platform, you see that $100 call trading for 20. Trading at parity, just the intrinsic value. That's the difference between the 120 stock price and the $100 call. So the question is, where did the $3 go? If we didn't really move through time, shouldn't this be trading for 123? $20 of intrinsic plus the $3 time that we had? Well, if it's not there, did the $3 decay? And if the answer is no, then where did it go? The thing to understand is that the time value or the extrinsic value is the cost of asking questions about the future. In other words, it's about trying to gather information. So we go back to this information time grid. What happened here is that yes, we didn't move through time, but we did rapidly move through information. We got an instant feedback that the stock is now 120, and so the option traded for intrinsic value of 20, even though we didn't move through time. So once you understand that we move through information time, we can explain things like this, which most traders struggle to understand how that's possible, because it didn't decay because we didn't move through time. The answer is we moved fully through information. Now, most of the time, we're going to move maybe on this diagonal and gathering some information over some time. And that's exactly what causes your stock price to kind of wiggle up and down. So the thing to understand is that the market sorts in the money and out of the money. That's ultimately what the options market is trying to do. So the way to think about the options market is not as a way for predicting up or down, but is to figure out which options will be in the money or out of the money. that's it. So it's like we have somebody at the front of the room saying, okay, you, Mr. $100 strike, you go into the in the money line. You, Mr. 120 strike, go into the out of the money line. But at what point does the options market make those decisions? Well, again, as time passes, new information reaches the market. And the market decides which tails are being eliminated. I've talked about this many times before. Options are tail bets. They are not directional bets. You're trying to figure out if the market has accurately priced the current information, not, I think it's going up or down and therefore I'm going to get paid if I'm right. That's going to get you hurt, and that's why a lot of traders end up being right about the direction but lose on the option because they're seeing it as a directional game. So at expiration, the market knows exactly where the stock has landed, and all calls to the left of that are in the money, and all calls to the right, including the current, the at the money strike, are out of the money. Now, why don't we have an at the money option here? Because when you get to expiration, at the money is just as good or just as bad, depending on how you want to look at it, as out of the money. It's going to be worth zero. So how does the options market move through time and start pricing options as either in the money or out of the money? Well, to do that, we're going to do a very interesting coin flip game. And we're going to flip a coin 10 times. And we're going to start right here at the number 10. Now, these numbers, 0 through 20, are going to represent strikes. Yeah, I know there's no such thing as a zero strike, but what I want you to do is to think of these as just strike prices. You could make this 100. You can make it anything that you want. They're just a placeholder for our strikes. So right now, if the stock is here at 10, all of these strikes are in the money. We're going to be assuming that these are calls. All of these are out of the money. So now we're going to get information. And to do that, we're going to flip a coin. And the beautiful thing about this model is that the coin flips represent information, but they also represent time. So here we have 10 units of time. You could make it 10 minutes, 10 days, 10 months. It's just that each coin flip represents some passage of time. We're going to start our stock here at 10, and anytime we flip heads, we will move up one step. If we flip tails, we move left one step. Each head moves us to the right, each tail moves us left. So this information is doing what it does to a stock. It either lifts it or lowers it. So before we start, we see that if we get 10 heads, we could get to 20, and if we get 10 tails, we could get to 0. Doesn't matter that that's unlikely. Those are possibilities. Okay, so now we start the clock, and we're going to get our first coin flip. Now remember, you can't see these. I've just got it here for demonstration purposes, but the first coin flip comes up tails. We have some information, and the market now says the stock moves to the left. Now here's where things get interesting. We have 9 units of time remaining. The very best we could do is to get from 9 plus 9 or to 18. There's no way that we could get to 19 or 20 heads. We used to be able to, but now we can't. So once this information hits the market says those two are no longer possibilities. They have gone delta 0. They've been knocked out of the picture. Even though time remains, the market's saying, yeah, we know there's time remaining, possibly even a lot. This could be 9 months. They're saying, according to a bell curve, or to the probability, these strikes are out. All right, so now we flip the coin again. We get some more information. We get heads. Now we step back to the right. What happens now? Now we have 8 units of time remaining. If we're at 10, could we get to 18? Yes, 10 plus 8 is 18. That's still a possibility, but 10 minus 8 is 2. See, we cannot any longer get to 0 or 1. They've been knocked out. Now, when I say knocked out, these are lower strikes. That means that they are in the money. These are delta 1. They've been knocked out of the extrinsic value. So they're trading at parity, even though there's still a lot of time remaining. So notice what happened. In the first case, when we moved left, we started knocking out the right tail because we're moving away from it. When we move right, we start knocking out the left tail. So let's try some more. We get another coin flip, we get some more information, we get tails. Stock moves down here to 9, but we have 7 units of time remaining. This is the part that traders forget. They say, oh, I bought this, let's say a 10-month option, and there's still a lot of time. I only need it to get back to where it was and I'll get my money back. Nope, the market is compressing these tails. And so now it says we're at 9, but we only have 7 units remaining. So 9 minus 7 is 2. Yes, 2 is still in play, but 9 plus 7 is 16. We can no longer get to 17 and 18. Those two strikes, they have no value. We get another coin flip. We get some more information, moves us back to heads. What happens? Now we have 6 units of time remaining. We could get 6 heads, possibly, put us up to 16. But if we have 10 minus 6, we get to 4. So the market says, 2 and 3 are no longer possible. We're going to knock them out. They are in the money. We feel that with the amount of time remaining and the amount of movement that it can make, volatility, these options cannot fall out of the money. They've gone delta 1. But now notice what's happened. We started at 10 and we've ended at 10. And yet these options have been priced very differently. See, this is the mistake that traders make. They say, oh, I've still got lots of time. As long as the stock moves up, that these options will come back into play. Not unless you get a significant move that the market never saw coming. So we get more information. We get heads, we move up, we have 11, we have 5 units of time. We could get to 16, but 11 minus 5 is 6. There's no way we can get to 4 and 5. Market says, those are delta 1. We get more information. We flip tails. We move back to the left, but we have 4 units of time remaining. So 10 minus 4, yeah, we could hit 6 down here, but 10 plus 4 could only get up to 14. 15 and 16 are now out of the money. We get some more information. We flip heads, we move to the right, but we have 3 units of time remaining. So 11 plus 3, yep, we could still get to 14. 11 minus 3 could only put us to 8. 6 and 7 are now knocked out. Or we should say maybe knocked in. They've now gone to delta 1. The extrinsic value is completely out of them now because the market is certain that these are going to be in the money relative to the amount of time remaining. That's the key. We flip again. We get some more information. We get heads. We step to the right, but we have 2 units remaining. Market says, yeah, with 2 units remaining, you could go from 12 to 14, but you could only fall down to 10. So now 8 and 9 have gone to delta 1. We flip, we get tails. What happens? We step to the left, and now the market says with only 1 unit of time remaining, yes, you could hit 10, you could hit 12, but no way to hit 13 and 14. Those have gone out. Now notice what's happening here. Even though this still might be a decent amount of time, let's say 30 days, we're now getting into high gamma territory because we are going to very quickly resolve which options are in the money or out of the money. So this is like with the final 30 seconds of a football game, it's tie score and one team's about to kick a field goal. We are going to resolve this game very quickly. So let's do it. We flip the coin, we get heads. What happens now? We know that we step to the right. We also know that these immediately go delta 1. So this is where people say, oh, the options are decaying quickly. Well, not really. They're resolving information quickly. And in that very last flip, we resolved a lot of information. So now we know from this one last flip, this very last unit of time, we know with 100% certainty where the stock is. It's at 12. We know that all of these strikes from 12 down are We know that all of these strikes from 12 up are worth 0. They have no extrinsic value, no intrinsic value, and we know that all of the strikes to the left of 12, below here, are all delta 1. They have intrinsic value and no extrinsic value, and that's because we have now resolved all information fully. We know for sure where the stock is. That's what the options market is trying to figure out. So once you understand that options are resolving information, it will change the way that you approach the markets. Don't fear the time decay or the apparent time decay. Say, what information am I learning? Don't say, well, I'm down 50%, so I need to close it and move on. What did we learn? Maybe we like it even more at these prices. But if you're not seeing options as an information across time game, you're going to see it in the wrong way and always be fighting time decay. That's not where the game is played. It's an information across time game. So now let's go over to an Excel spreadsheet and see this identical idea in action. So now we're into an Excel spreadsheet, and what I've done is I've created a stock at 200, and I did that just so we could get these tails to come all the way down here to 0. We have 40% volatility, and both curves have 360 days to expiration. That's why we're only seeing the one red curve, because they're both identical. But now, just like we saw in the coin game, what happens if time goes by? The market starts to resolve information. So let's say that 60 days has gone by and we have only 300 left. Let's make that 300 and watch what happens. Do you see how the curve has now compressed from the tails inward, exactly like we saw with the coin game? Let's make it 180 days. So we come down here to 180, and look at that. Start compressing even more. So the point is that as time goes by, let's go down to 30 days. See, this is the gamma I was talking about, like the field goal in the last 30 seconds of a tie game. We are going to resolve very, very quickly. All of these tails have gone to 0. So watch what happens when we go to 1 day. See, it's just a spike, and that's not because options are decaying quickly in the final days. It's because they're resolving information quickly. We know exactly where that stock is going to be, or how the game is going to end, so to speak, very quickly. And as we keep going, you can see this is just going to keep getting narrower and narrower. All right, now let's go back to 360. But let's say that volatility comes in. This is where traders make a mistake if they, let's say, roll out to a long-dated option because their position has gone against them, but during a high volatility environment like we've been in. And so they roll out to these long-dated options with high vol, but watch what happens when the volatility starts coming back in. Let's say it moves from 40% to 20%. See, those tails just got compressed very quickly. So that would be like saying the coin only counts for a half a move, or going from 20 to 40 that it counts for 2 spaces. Every head allows you to jump 2 spaces to the right, or every tail allows you to jump 2 spaces to the left. That's a change in volatility. Suddenly these options that you thought were either in the money or out of the money come alive again. So here's the final point to take. If we go back to 40%, you all know the square root pricing rule that we've talked about. If I make time 1/4 the amount, we should have, the curve should move in by half. So let's make this 90, 1/4 of 360, and the red curve is now half of the black. But watch what happens if we go back to 360 and I knock volatility in half. Not 1/4, but in half. And we get exactly the same curve. So part of the story is to understand that volatility penalizes you far more. So if you're rolling out to these leaps options during very high vol and it collapses, those options are going to get compressed into the tails very, very quickly. And now you let time start to come in, even if it's just 60 days, you can see it starts coming in very quickly. So that's the thing that I think is super important for options traders to understand, that options are about an information over time game. Learn to ask, what information did I learn? Do I still want to stay in it? Because if you see it as strictly a time decay game, you're going to see it as, I think it's going up or down, and now it's a fight against the clock. And that is not what options were designed to do. They were designed to be a sorting machine over time. And for anyone who'd like to learn more about the art and science of options trading, please check out the Alpha Trader course, Strategy Lab, and a Candlesticks and Technical Analysis course. It's all at optionsatoz.com. Also, please join us on Options A to Z's Facebook trading group, and you can find a link in the description below.